Today, we're going to break down a really powerful tax strategy for business owners. It's one that uses a vehicle purchase to make a direct hit on your bottom line. And look, this isn't just about buying a new truck or SUV. It's about understanding a very specific lever inside the tax code. So, this is the big question, right? It almost sounds too good to be true. How can you possibly buy a huge asset, maybe even a luxury vehicle, and have that purchase translate into a direct dollar-for-dollar cut in your taxable income? Well, that's exactly the mechanism we are about to unpack. And here's the secret. The key isn't the price tag, it's not the brand, it's not how powerful the engine is. The entire strategy gets unlocked by one simple physical fact: the vehicle's weight. That one number triggers a set of very specific, and believe me, very powerful rules in the tax code. Okay, so to really get this, we're gonna walk through it step by step. First, we'll cover the core concept, what's called the heavy vehicle exception. Then, we'll define the most important term you need to know, GVWR. After that, we'll look at the legal engine that drives the whole thing. Talk about the absolutely critical 50% business use rule, run through a real-world calculation, and then wrap up with the one thing that can make or break this whole strategy, your documentation. All right, let's jump right in with part one, the heavy vehicle exception. Honestly, this is the foundation for everything else we're going to talk about. So here it is, the magic number, 6,000 pounds. You see, normally when you buy a vehicle for your business, you have to depreciate its value over several years. But the tax code basically creates this special fast lane for vehicles that weigh over 6,000 pounds. It allows for a much, much faster and often complete write-off, all in the very first year. And that weight limit brings us to probably the single most important detail in this entire strategy. It's all about understanding what's called the gross vehicle weight rating, or GVWR. Okay, so this is absolutely crucial. GVWR is not what the vehicle weighs when it's empty. It's the maximum safe operating weight when it is fully loaded up. So think of it as the car itself, plus all the fuel, all the passengers, all the cargo, everything it's designed to carry safely. It's the total potential weight. And this right here is the classic trip up. This is where so many people get it wrong. They'll look up a vehicle's curb weight, what it weighs sitting on the dealer lot, and they'll think, oh, it doesn't qualify. But the tax code doesn't care about curb weight. It only cares about GVWR. This is a super non-obvious detail, and frankly, it's a distinction that even some tax pros can miss. So what kind of vehicles actually fit this description? Well, we're usually talking about a pretty specific class of asset. You've got your heavy SUVs, your full-size pickup trucks, cargo vans, and believe it or not, even certain really big luxury sedans can often meet this GVWR requirement. Okay, so now let's pop the hood and look at the legal engine here. What parts of the tax code are actually making this incredible deduction possible? It really comes down to two key tools. First, you have Section 179. This lets you expense the full cost of an asset right away, instead of depreciating it over years, but it does have annual caps. Then you have bonus depreciation. This is an extra first-year deduction that, in the past, has let businesses write off 100% of an asset's cost in year one. When you put them together, they deliver this incredibly powerful one-two punch for these qualifying heavy vehicles. But, and this is a really important heads up, the power of these tools can change. Bonus depreciation, for instance, has been phasing down over the last few years. It was 80% in 2023. It's scheduled to be just 40% in 2025. It just goes to show you that the effectiveness of this strategy is directly tied to whatever the current law is. And that stuff can always change. Now for the next part, which is an absolutely critical safeguard. This is the 50% business use rule, and let me tell you, it is a hard and fast mandate you just cannot ignore. Yeah, expert analysis is crystal clear here. Your ability to take these amazing deductions depends entirely on the vehicle being used primarily for business. So if more than half the miles you put on that truck are for personal trips, this whole strategy is completely off the table. It's a bright line test. There is no gray area. And the consequences if you mess this up, they're pretty severe. If your business use dips below that 50% mark in a later year, you can get hit with something called depreciation recapture. That's when the IRS basically claws back the tax benefits you already took. It's a huge mistake that can create a massive red flag on your return. Okay, so let's get practical. Let's run the numbers and see what this actually looks like on paper, the direct financial cause and effect. So let's just use a nice, simple, round number. Let's say a business goes out and buys a qualifying heavy vehicle for $150,000. Now, check out the impact. Before buying the vehicle, this business has $250,000 in taxable income. But after, by using this strategy, the full $150,000 purchase price gets deducted. And just like that, it slashes their taxable income all the way down to $100,000. The purchase of the asset turns into a direct, immediate reduction of the company's tax bill. All right, we've arrived at our last step. This is the part that literally makes or breaks the entire strategy if you ever get audited. Your documentation is completely 100% non-negotiable. And I'm not just being dramatic here, this is a real thing. There was a tax court case in 2023 that perfectly illustrates the risk. The court just flat out disallowed the deductions because the paperwork was a complete mess. The mileage logs didn't match up with each other, receipts look like they've been altered. The bottom line is, without solid proof, your deduction is worthless. So what does good documentation look like? Well, the law itself, Section 274D, is super specific. For every single business use, you have to meticulously log 4 things: the cost, the date, the location, and, this is the most important one, the specific business purpose. Keeping a detailed, up-to-date mileage log is absolutely essential to proving you've met that critical 50% business use test. So when you take a step back and look at the whole picture, this is way more than just a tax loophole. It's a mechanism that lets you turn a depreciating asset into a powerful tool for reallocating your capital. The money you save on taxes isn't just savings. It's capital that you can now reinvest into growing your business. And that leaves us with the final and maybe the most important question of all. What is the highest and best use for that freed up capital in your business?